The execs will tell the committee proposed new rules for banks could stifle lending and hurt the economy. For more on that, let's go back out to Leslie Picker, who is at the Goldman Sachs Banking Conference with a special guest. Leslie?
Hey, Kelly, yes, a very perfectly timed conference, one hosted by Richard Ramsden, the analyst who covers banks and financial institutions. Richard, thank you so much for being here. So we just hit on some of these testimonies that are expected to be delivered in front of the Senate Banking Committee tomorrow. Key focus, you've done a lot of work on this, is the Basel III endgame rules. I'm curious, what parts of these rules do you think will get the most pushback, and what will they be the most successful in pushing back on that could ultimately lead to some watering down of these rules that they say will be so harmful to credit and the economy and so forth?
So the Basel III proposals have obviously been in focus now for 6 months. It's obviously been a key focus at this conference. Pretty much every large bank that's presented has spent quite a lot of time talking about these. I mean, if you take a step back, what these proposals will do is significantly increase the capital requirements on the largest banks. And I think, look, what the largest banks are saying is, look, this could fundamentally change the way that they think about certain businesses. And it will change the way in which they approach certain types of lending decisions, whether that's lending to households for mortgages. It will change how they think about pricing loans for small businesses. It could have ramifications on liquidity in financial markets that could impact things like the treasury market. So look, these banks are really, I think, saying, look, holistically, these proposals are very far-reaching, and there hasn't been a cost-benefit analysis that's been done that really thinks through, look, what is the ultimate cost of these proposals relative to the benefit, which is that you will obviously have a safer banking system on the other side of it.
And that's a ubiquitous sentiment among the largest bank CEOs. You've done that cost-benefit analysis. You've seen kind of the impact in your modeling of what these rules would do. Do you think ultimately, given those results, they will be watered down?
I think what's interesting is pretty much every bank CEO that has talked today has said that their expectation is that these rules are going to change. I don't know if there's agreement on exactly what's going to change, but broadly, I think most banks think that the change in risk requirements on, say, mortgages that could impact lower income households is likely to be an area where there are likely to be changes. The significant change in capital requirements on lending to renewable energy companies is another one, which I think most of these banks, think could change. But I think what they're hopeful for is that there will be enough pushback, from politicians that the whole framework gets called into question, and they go back to the drawing board and come up with something which is quite different to this proposal.
Fascinating. Kelly has a question for you in studio. Kel?
Appreciate it. Richard, if you don't mind, could you just talk a little bit about, have banks been disintermediated by the growth of private credit, which is obviously within some banks, but also without, and other such institutions, the growth that we've seen over the past decade? How vital, when they're making these arguments to regulators, how vital is it that economic activity is flowing through the banking system?
So I think that is an area which, again, I think will come into focus tomorrow in these hearings. I mean, if you look at the data, it is really clear that certain parts of the regulated banking market have shifted out of the banking system over the last decade. I mean, if you look at mortgages, you go back in time, I mean, the majority of mortgages were underwritten by banks. Today, the majority of mortgages are not underwritten by banks. I mean, if you look at the role that banks play in terms of credit provision, especially to non-investment grade companies, that's obviously been declining. And the tremendous growth in terms of private credit assets means that that will continue to migrate out of the banking system over time. I think, look, the focus, though, is this creating new types of risks that regulators need to think about. So I think what the regulators care about is not so much, is the banking system competitive, but are we seeing pockets of risk emerge outside of the regulated banking system that could cause issues further down the road?